Silver looks supported, yields are softening, the dollar is slipping, but underneath the surface, leverage is building, and that's where the real risk lives. Welcome back. I'm James. Today is February 12th, 2026, and this is your macro breakdown on silver. If you're serious about understanding markets, not chasing headlines but understanding structure, make sure you're subscribed. Drop a comment with where you're watching from, and tell me right now, are you bullish or cautious on silver at these levels? Because silver is sitting at a macro inflection point. The backdrop looks supportive, but the structure is fragile. Let's unpack this calmly and step by step. Silver trades off three primary macro levers: real yields, the dollar, and liquidity conditions. Right now, the US 10-year yield has eased to around 4.16%. At the same time, the dollar index has drifted toward 96.9. That combination is marginally supportive for precious metals. When yields soften, the opportunity cost of holding non-yielding assets like silver decreases. And when the dollar weakens, silver becomes cheaper for international buyers. So on the surface, macro is cooperating. But here's the cliffhanger. Cliffhanger number one: if macro is supportive, why is silver still vulnerable to a sudden drop? To answer that, we need to talk about positioning. Silver futures open interest is sitting around 165 contracts. That's elevated participation. It tells us a lot of traders are involved in this move. Now look at the positioning breakdown. Non-commercial traders, typically hedge funds and speculators, are holding roughly 72,318 long contracts versus 20,042 short contracts. That's a strong net long bias. Commercial participants, producers, and hedgers are roughly 42,281 long versus 115,036 short. That's typical. Producers hedge into strength. They sell forward production when prices rise. But here's the issue. When speculative positioning becomes heavily skewed to one side, the risk isn't that there are no buyers left. The risk is that too many buyers are already in. When a trade becomes crowded, it becomes fragile. It doesn't take a collapse in fundamentals to trigger a decline. It just takes a shift in conditions, a bounce in yields, a stronger dollar, or a tightening in financial conditions. And this is where margin mechanics come into play. Let's explain this in plain language. When you trade silver futures, you don't pay the full value of the contract. You post margin, essentially collateral. It's a performance bond. If volatility increases, the CME can raise margin requirements. That means you need more capital to hold the same position. Recently, CME margin regimes have tightened, in some profiles up to around 15%. That increases the cost of leverage. Now think about this combination: elevated speculative longs plus higher margin requirements. If silver dips and traders are highly leveraged, they may receive margin calls. And margin calls force selling. Not because traders change their thesis, but because they don't have enough capital posted. That's how flushes happen. Cliffhanger number two. What happens when crowded speculative longs meet rising margin costs and even a modest macro reversal? You don't get orderly selling, you get air pockets. Before we map that risk fully, let's zoom out and look at cross-asset context. Silver does not trade in isolation. Right now, yields are softening and the dollar is drifting lower. Equities remain relatively stable. That's a constructive environment for metals. But what would break this setup? If the 10-year yield reverses sharply back above 4.25% or higher, that changes the opportunity cost calculation. If the dollar index reclaims strength above 98, that tightens financial conditions for metals. Silver is deeply sensitive to liquidity shifts. It is not just an industrial metal. It is also a monetary asset and a speculative vehicle. So even though the macro backdrop is currently supportive, it is not locked in. It can reverse. That's why I describe this environment as constructively bullish, but structurally fragile. Macro tailwinds are present, but positioning makes the path unstable. Let's talk levels. On the downside, watch yesterday's low and the weekly close. These are near-term support references. If price breaks below those levels decisively, it increases the probability of a positioning unwind. On the upside, yesterday's high and psychological round number zones matter. Silver traders pay attention to round numbers. Breakouts above those levels can attract momentum traders. And momentum traders often use leverage, which loops us back to the margin dynamic. Cliffhanger number 3. So which happens first, continuation higher or a positioning flush? Let's break it into two clean scenarios. Scenario A is bullish continuation. This scenario gains credibility if the 10-year yield continues drifting lower, ideally below 4.10%. The dollar weakens decisively below 96. Silver holds above weekly support and open interest rises alongside price. If price rises and open interest expands, that suggests new buying is entering the market. That's constructive. That's expansion, not short covering. In that environment, silver could press into higher psychological zones. Volatility would likely remain elevated, but the trend would be intact. Now, scenario B is the positioning flush. This triggers if yields reverse sharply higher, moving back above 4.25%, if the dollar strengthens toward or above 98, if silver fails at resistance and starts slipping below support, and critically, if open interest declines as price falls. When price drops and open interest contracts, that signals long liquidation. That's traders exiting positions. Given the elevated speculative long bias and tighter margin conditions, that unwind could accelerate quickly. This would not necessarily invalidate the longer-term macro case for silver. It would simply represent a structural reset. And these resets in silver are rarely slow. They tend to be sharp, emotional, and fast. The primary risk right now is not the absence of macro support. The primary risk is leverage concentration. When positioning is crowded, margins are tight, and volatility is elevated, price moves become nonlinear. Silver doesn't drift lower gradually. It can gap lower as leveraged traders are forced to de-risk. Understanding this helps you stay calm. It prevents emotional decision-making. This is education only, not financial advice. Always manage your own risk. So what would strengthen the bullish case from here? A gradual cooling in positioning while price holds steady. That would reduce fragility. Open interest stabilizing instead of expanding aggressively. Margins holding steady without further hikes. Markets are strongest when participation is balanced. When everyone agrees, risk increases. Right now, many participants are leaning in the same direction. That's why discipline matters. Let me leave you with a clear checklist. Here's what I'm watching next. First, the US 10-year yield. Sustained movement below 4.10% would reinforce the supportive backdrop. A move back above 4.25% would pressure metals. Second, the dollar index. A decisive break below 96 strengthens the bullish case. A reclaim of 98 shifts the tone. Third, open interest behavior. Rising with price suggests expansion. Falling with price suggests liquidation. Fourth, CME margin adjustments. Any additional hikes increase the probability of forced selling in a downturn. Fifth, reaction at key support and resistance levels. How price behaves at yesterday's high, yesterday's low, and the weekly close will reveal whether buyers remain in control. Silver sits at a macro inflection point. The backdrop is supportive. The structure is crowded. Leverage is elevated. If macro continues cooperating, silver can extend higher. If cross-asset conditions reverse, leverage becomes the story. This is why we study structure, not just headlines. Now I want your view. Do you think silver breaks higher first? Yes or no? And which signal matters most right now? Yields, the dollar, or open interest? Pick one. I'm James. Today is February 12th, 2026. Stay objective. Stay disciplined. Manage risk. I'll see you in the next one.